The Rise and Fall of a Hedge Fund, a Case Study in Financial Misconduct. In this section, you will examine the rise and subsequent collapse of a hedge fund managed by an individual who, after facing serious criminal charges, found himself navigating the United States justice system. The individual in question was once at the peak of financial success, overseeing a billion-dollar hedge fund. However, mismanagement, fraud, and falsified financial reports ultimately led to his undoing. You will analyze how fraudulent activities were executed within the firm, including the misappropriation of investor funds. These actions were not limited to financial mismanagement, but were also compounded by deceptive marketing to recruit new investors. False reports about the performance and longevity of the fund were disseminated, leading investors to believe they were making strong returns when, in fact, the fund was already deeply in debt. The core issue in this case lies in the misrepresentation of financial results and the fraudulent recruitment of investors, which ultimately led to substantial financial losses. Footnote: This section outlines the unethical practices that led to the failure of a hedge fund, underscoring how misrepresentation and fraudulent tactics can result in significant financial damage. The impact of Wall Street's immunity. In this part, you will delve into the broader implications of the financial crisis, highlighting the fact that the major players on Wall Street, who contributed to the collapse, were not held accountable. While smaller individuals were criminally charged and faced the justice system, top executives responsible for the financial decisions that led to the global crisis remained largely unscathed. This disparity in accountability raises critical questions about the fairness of the legal system and the power dynamics within financial institutions. Despite widespread evidence of financial misconduct, there was a notable lack of consequences for the executives who played a key role in orchestrating the collapse. This section challenges the notion of equal justice under the law, particularly when it comes to financial crimes, and suggests that the system disproportionately punishes the smaller actors while allowing those at the top to avoid accountability. Footnote: This section discusses the lack of accountability for top executives involved in the financial crisis, questioning the fairness of the justice system. The system's role in creating and perpetuating financial misconduct. In this section, you will explore how the systemic nature of financial misconduct contributed to the financial crisis. Key to understanding this crisis is the role of banks and financial institutions in creating and marketing high-risk loans, such as subprime mortgages. These loans were packaged into complex financial products, sold to investors, and ultimately triggered a massive economic collapse when they defaulted. The most notorious of these loans were ninja loans, loans given to borrowers with no income, no job, and no assets. These predatory lending practices were instrumental in inflating the housing bubble, leading to the global financial crisis. The responsibility for these actions lies not just with the borrowers who took on these risky loans, but also with the banks and financial institutions that pushed these products to increase their profits. This section examines the moral and legal implications of these actions, focusing on how financial innovation was used to exploit vulnerable borrowers and deceive investors. Footnote: This section highlights the systemic role of financial institutions in perpetuating high-risk lending practices that contributed to the housing crisis. Accountability and the aftermath of the crisis. Here, you will reflect on the aftermath of the financial crisis, particularly the lack of criminal charges against top executives from major financial institutions. Despite widespread evidence of fraud and mismanagement, the legal system failed to hold these executives accountable for their actions. Instead, individuals who were less powerful in the financial world were prosecuted, leaving the true perpetrators free from justice. This section also discusses the broader societal and economic consequences of the crisis, which included mass foreclosures, job losses, and economic instability. The lack of legal repercussions for the key players involved in the crisis raises significant questions about the fairness of the justice system and the power of large financial institutions. Additionally, you will consider the long-term effects of the crisis, including its role in shaping political outcomes such as Brexit and the election of Donald Trump. The financial collapse altered the course of history, influencing global politics and economics in profound ways. Footnote: this section examines the lack of accountability for top financial executives and discusses the long-term societal and political repercussions of the financial crisis. Looking forward, the seeds of a new crisis. In this final section, you will explore the potential for future financial crises, noting that the same patterns of greed and lack of accountability are already taking root. While the public and decision-makers may have forgotten the lessons of the 2008 crisis, the financial industry has learned from its mistakes, and many believe that another crisis is inevitable. You will discuss the warning signs of the next financial meltdown, driven by the same forces of excessive risk-taking and the pursuit of profits without regard for the long-term consequences. This section emphasizes the importance of recognizing these patterns early and taking action to prevent another catastrophic financial event. Footnote: this section forecasts the potential for another financial crisis, highlighting the lessons not learned from the previous one and the dangers of ignoring warning signs.